In this lesson, you're going to learn how to project the cash flow statement for Apple over these 5 years from 2010 through 2014. Now, in the previous video, we had created our balance sheet projections right here, which gives us a lot of the information that we actually need to complete the cash flow statement projections as well. What's missing now is that we need to look at some of the income statement items as well as some of the balance sheet items and how they change over time, and then incorporate those to create our cash flow statement projections. You'll notice that in this case, I have not divided this into a separate video for cash flow statement trends and then one for cash flow statement projections. And the reason that I've not divided it like that is because in this case, there's really only one item where we have to look at the trends, and that is the capital expenditures line item that you see right here. So we have far fewer items to project than we did on the income statement or balance sheet here, because really the cash flow statement, a lot of the items are just going to be constant all the way across. We'll set them to 0, or they'll be flowing in from the income statement or balance sheet. So we have less in the way of standalone projections that we need to make for the cash flow statement here. So to get started here, I'm just going to go to the top, and we're going to start with net income and linking in some of these items on depreciation, amortization, and stock-based compensation. So for the net income, remember that this flows in directly from the income statement. So I'm going to go up to the income statement and link in net income right here. Depreciation and amortization of PP&E, we're going to go up to the income statement again. And you see that amortization of intangibles and stock-based compensation are listed right below that as well. So actually what I can do here is Control C and then Alt ESF to copy this formula down. And if you press F2 or Control left bracket now, you can see that it's being properly linked to stock-based comp and the other amortization line item as well. Now for the deferred income tax expense and loss on PP&E here, so for these we're basically going to assume 0 all the way across, and the reason is because we do not have detailed enough information to make reasonable estimates or projections here. Now this deferred income tax line item we'll actually be coming back to in an upcoming video in this course, where I go over how deferred tax liabilities get created, how they change over time, and then finally how they disappear at the end of a certain period. But for right now, we're going to be setting this to 0 all the way across, because you could create a complex schedule for this, but honestly, you're not going to get questions about it in investment banking or private equity interviews, so we're just going to set it to 0. Same for loss on PP&E. Unless you have advanced information on this, it's safest just to set this to 0 all the way across. So I'll say 0 for both of these. Now for the changes in operating assets and liabilities, remember here that when an asset goes up, it is our drain on our cash flow, so our cash flow is going to go down. And on the liability side, the reverse is true. When a liability goes up, our cash flow goes up. So accounts payable here is going up, so our cash flow is going up as well. Now you see here that for 2009, we've actually already entered all these formulas. You saw it in our accounting model before, the simple 3-statement model we looked at. It had all these formulas already. So I don't want to repeat the same exact work here. I don't want to repeat work that we've already done once. So actually what we can do here is just take everything that we have, Control C, and then Alt ESF to paste it over here. So now we have everything there. The final step here is to just take everything, use Shift Control down arrow key to select everything. I'm going to scroll up a bit, and then Control C, and then Shift right arrow key a few times, and then Alt ESF to paste all the formulas here. And so now we have our cash flow from operations projected for 2010 through 2014. There's actually almost nothing in the way of real projections that we created here. Really, all we actually did here was tie in a lot of the items from the income statement and balance sheet, and then also assume 0 for some of them, like the deferred income tax expense and loss on PP&E. For investing activities and financing activities, it's actually going to be even simpler than that, because all these items like purchases of securities, proceeds from securities, long-term investments, intangibles, other, we're going to set all these to 0, and this is typically what you do in projection models like this, because if you think about it, all these items are basically one-time expenses. A company may purchase securities one year or they may mature, but it's not like they're doing this on a consistent schedule. If you think about a line item like revenue or expenses, any company that's selling anything is always going to have revenue and expenses, and assuming that they're growing at a certain rate, they're probably going to be tied to that. But when you deal with investing and financing activities, the movement is a lot more random. What you do is typically exactly what we have here. We set this to 0 and then just use these numbers all the way across. So I'm just going to sum up everything here. I'm going to use the sum formula here. One other thing I want to do here is make sure that I'm actually setting the second column to be equal to the first column as opposed to just copying it. And I'll do the same for the sum here at the bottom. The reason I'm doing this is because we don't want to hard code this all the way across. We want to set it to some constant number in year 1 and then use that constant number all the way across. So it needs to be linked as opposed to copied here. And I'm actually going to go up and change what we did for deferred income taxes and loss on PP&E as well to reflect that. And I'm just pressing F2 to check the rest of these formulas. So we have that in place, and what I'm going to do now is just copy these numbers formulas across with Alt-ESF. Now the one item under investing activities that we do want to project here is capital expenditures. So let's go up to the top to our operating assumptions schedule. And you see here that I am projecting CapEx as a percent of revenue here. Now in real models used at banks, you could sometimes do something more complex than this. So one common tactic at banks is to create what's known as a PP&E schedule, where you split capital expenditures into land, buildings, factories, equipment, and so on. And you assume that they spend a certain amount, they invest a certain amount in buying new land, new buildings, new factories, new equipment each year. And then after you buy that, it then depreciates by a set amount each year, or maybe you have something more complex than that. Maybe it depreciates by a certain amount in 1 year, then it decreases or increases after that. So you could create a PP&E schedule like that. We're not going to do it right here because this is already covered in the advanced modeling course here, and because in interviews, again, you're honestly not going to get questions on this in investment banking or private equity interviews. It's just something to be aware of once you start working, that you might see something more complex like that. And again, if you want more detail on this, look at the advanced modeling course where we go into an example of how to create such a PP&E schedule. But for our purposes, we're just going to make a very simple projection here and say that capital expenditures are a percent of revenue. So I'm going to go down to cash flow statement, take capital expenditures. I'm going to change the sign here because it's negative. And now I will divide this by revenue. We're assuming that CapEx is linked to revenue here because if you think about it, to fund a company's growth and expansion and to fund future revenue growth, they need to invest in factories, in assets that are going to produce income for them. So it makes a lot of sense that capital expenditures here will be linked to revenue. This is really the most common way to project it if you're going to do a simple assumption like this. It would be very odd to project this as a percentage of PP&E or as a percentage of depreciation and amortization. Usually it's the other way around. Usually depreciation and amortization might be projected as a percent of CapEx, but CapEx itself is almost always linked to revenue, or you could do something more complex and split it out by separate assets. But again, there effectively you'd still be linking everything to revenue in some way, shape, or form. So we're going to take this, copy this across now with Alt-ESF. You see that it's generally decreasing as a percent of revenue. What I'm going to do here is just link it to the historical number for 2009 and copy this formula across with Alt-ESF. Now I'm going to go down to the cash flow statement. And for capital expenditures here, I'm going to enter a negative sign first because that's the sign we're using here. Go up to CapEx as a percent of revenue, and then link it to revenue right here. So you have that in place, and I'll copy this across with Alt-ESF. Excel is giving us some errors here because it's saying this formula doesn't resemble the other ones around it. We can actually just ignore those. I'll click on the exclamation mark right here and just say ignore error. So we have cash flow from investing and operations projected here. Next, we want to move into financing activities. And again, this is actually going to be very, very simple except for one item here, which is the raising and paying off of long-term debt. So for pretty much all these items, I'm just going to set them to 0. So we're going to assume that they're not issuing common stock, they're not repurchasing common stock, they're not issuing dividends, they don't have tax benefits from stock-based comp, and they're not issuing anything for equity awards. The reason we're doing this is because, again, it gets dangerous to make assumptions about a company actually issuing stock or repurchasing stock in future years, because oftentimes these are one-time events. So if a company decides to go back to the equity markets and raise money from investors, that's fine, but it's a one-time event, and generally you're not going to plan that far in advance, 5 years in advance here. So it's usually safest to set these all to 0. And the other point here is that we also want to be careful that if we were to not set these to 0, we had them set to some constant number going all the way across. So I'm going to link in each of these to the 2010 number that I have here. And this just makes our model more flexible because, again, in future years, we might want to be changing this around, or maybe at some point in the future, we'll want to make a different assumption and say that they issue 100 million of common stock each year, or they repurchase a certain amount each year. And this just lets us take advantage of this and make our model flexible enough to handle that scenario. So what I'm going to do here is just sum up everything and then copy these formulas across with Alt-ESF. Now for the raising and paying of long-term debt right here, what we're going to do is go up to the top first. And remember here that I've set a debt issue date of 2010 and a debt amount of 1 billion. I'm also going to open this tab right here. I just had this hidden. I just went over here and just clicked on the plus and minus tab to open this. What you see here is the numerical year listed below each of these. And so what we want to do here is make our model flexible again, and we want to make sure that we can issue the debt in any year we want. So it could be 2010, it could be 2011, but we always want to issue this $1 billion worth of debt in the year that we have listed here. So what I'm going to do is go down to the raising and paying of long-term debt. I'm going to say, I'm going to make an if statement right here, which is common in Excel. To do this, all you do is type equals if, and I'm using Control arrow key to move up to the top here. I'm going to say if our year right here is equal to our debt issue date, then we want to issue our debt amount. Otherwise, we'll set this equal to 0. So I'm pressing F2 to look at this formula now. So that's really all we're doing. We're looking at our current year. We're checking whether or not it equals the debt issue date. If it does, then we're issuing the debt. Otherwise, then we enter 0 right here. Now you'll see here that these are named variables in Excel. So these have names assigned to them. That's just to make it easier for us to look at them and see instantly what's going on here. You might be wondering, why is it that we need to have this extra row of years? The short answer is that if we just had this right here, FY 2010 would not be equal to our debt issue date, and we'd like to have everything in numbers in addition to just text here, just for our own reference. So I'll close that now. And I'll copy this formula for raising and paying off long-term debt all the way across. So we have that in place. Once again, I'm just going to ignore these errors that Excel is giving us about the formula being inconsistent. So with all that in place, now we can actually get to our increase or decrease in cash and our cash and cash equivalents at the end of this period. So we already have these formulas in place from 2009. So easiest thing to do here is just to copy these across. The formatting is a little messed up here, so I'm going to go to Control 1, border, and then get rid of this middle border that you see. Click on the left one to get rid of the left border, click on the right one to get rid of the right border there. We also want to go back to our balance sheet now and make sure that this is being linked properly, because right now these numbers are all off. So for cash and cash equivalents, I'm going to go down to our cash flow statement and link in from right there. So we have that set up. Just pressing Control bracket to look at all these numbers now. And it looks like these are all being pulled correctly. You're taking the previous balance sheet, you're adding the cash flow in the current period, and then you're using that cash number for the current balance sheet. So it looks like all that is flowing through correctly. So that's how we set up the projections for our cash flow statement here. As you can see, it's actually very simple, at least on the financing and investing activity side. really the only items that we're ever going to project here are capital expenditures. And then the financing activity side, if we have reason to believe that one of these will change, typically we assume a constant change. If we have knowledge that debt is going to be issued in 1 year, then we'll include that as well. But the projections there are very straightforward for the most part. On the operating activity side, again, most of the items are flowing in from the income statement or balance sheet, so those projections are also fairly straightforward. If there's something more complex going on, then we might have to do something a little different. We could create a complex schedule for some of the items like deferred income taxes, but usually we set those to 0 for projection models like this because it barely makes a difference when you have a model for a complex company like Apple anyway. So that's how we go through and project our cash flow statement. Coming up in the next video, we're going to get started with linking together our statements here. We're going to correctly enter a lot of the links between the balance sheet and cash flow statement, and then we'll also look at the interest expense and interest income from debt and cash and make sure that those are flowing correctly through the 3 financial statements.